Okay, so today I want to talk about monetary policy and what it is and when it's used and why it's used. It's an economic policy that the government often uses, um, and it controls the quantity of money in the economy. It is a demand side policy, so if the government wants more demand, aggregate demand in the economy, to increase the activity, economic activity, it can introduce more money in the economy. Or if it wants to reduce inflation, it can reduce the quantity of money. But actually, the the objectives are established by the government, but it's a policy normally carried out by the central bank, and it's kept independent of the political masters, because we know, the politicians can be thinking about their electoral success, and maybe in England, in the UK, normally the Bank of England is set an objective: keep inflation under, I don't know, 3% or 2%, and then that's what they'll do. And that's the same in America. They have this independent central bank that carries out a monetary policy according to pre-established objectives. The tools of monetary policy, how we increase or decrease the quantity of money, is or can be interest rates. Got to remember, money is also debt. We spend debt, so it's anything we spend, whether it's debt or credit, that's money, and that can increase the aggregate demand by increasing debt in the economy. So interest rates can regulate this. If we want more money in the economy, we reduce interest rates, and suddenly people will be borrowing more, or maybe they'll even be spending their savings, because there's a correspondent reduction in interest rates on your savings if interest rates go down. So that's one tool. It can be if the money supply might be very, very primitive in terms of modern economies, and it might be mainly just notes and coins, just printing less notes and coins could reduce the money supply, or increasing notes and coins can increase it. Credit regulations, the governments often have regulations to stop banks lending irresponsibly. They can be changed. For example, there's a minimum requirement of cash to be kept in a bank. Sometimes it can be something like 10%. If they want more money in the system, they can reduce that to 5%, and then the banks can lend out more money. They don't need to keep so much cash and liquidity in them. In the American recession, or in the 2007 recession, which was started in America, the regulations were very loose for banks lending, because the banks knew they could lend to whoever came through the door, and if they bought the property with it, the property prices were always going up, and so they could lend to whoever, and that ended in a housing bubble which burst. So these credit regulations can be changed to increase or decrease money supply. Yes, it is a demand side policy, so an expansionary monetary policy, one which expands the economy, increases aggregate demand by increasing the money supply. Here, the tools could be a reduction in interest rates, or maybe an increase in printing money, or maybe a restriction of credit regulation, so there's less regulations and banks can lend to more people. This is a way of having expansionary monetary policy, so hopefully this will expand the economy by expanding aggregate demand. Contractionary monetary policy will reduce the aggregate demand by reducing the monetary policy. Here, obviously, we do the opposite. So an increase in interest rates will mean people put money in the banks and save it instead of spending it, and not, maybe they don't borrow, maybe businesses don't borrow to invest, etc. And that means a decrease in the money supply. Or you know, they can stop printing money or slow the printing of money and have more restrictions in bank lending. So monetary policy is mainly used to influence inflation. So normally it's used by the central bank to really keep a lid on inflation, stop inflation getting out of control. So it will, you know, regulate the flow of money according to the price stability the economy has. It can control demand pull inflation. That's the objective, by reducing the money supply. So we're looking at demand pull inflation. By reducing the money supply, people will have less money to spend, so there'll be less demand. Yes, like I said before, banks are given a specific inflation limit to keep within. That's normally the case. Sometimes, you know, in Italy, these objectives are written in the constitution. You know, there's an article in the constitution to protect savers. So they you know, the government must be financially responsible, and this should help with inflation, to protect savers. Maybe an increase in interest rates stops borrowing, but also encourages savings. So, yeah, again, it doesn't just stop the borrowing, the interest rates, but also it's there to really attract the money from the economy. And maybe instead of investing, if the interest rate is 10%, very high, and I know if I invest I can get 5%, obviously it's better for me to stick it in the bank. It's more secure, there's less risk, and I'm getting a higher return on my money anyway. So it should encourage savings and draw the money supply out of the economy in that way too. Doesn't always work. It does take time for the monetary supply to see effects, quite a long time. And maybe it doesn't work if, for example, the central bank raises the interest rates. It doesn't mean that the end customer will have higher interest rates, because the commercial banks will have to pay the higher rate, the reference rate. But it doesn't mean they're going to put up their interest rates to the final customer, which will mean that maybe the demand won't change. Maybe the supply of money won't slow down. Also, consumers might be very optimistic. A lot of it is psychology, you know, fiducia. After the 2007 recession, the government in Italy was always talking about la fiducia, the confidence, consumer confidence. And if they're optimistic anyway, it doesn't matter if we put up interest rates, they'll still keep spending because they'll still feel they can borrow and they're still going to have a job and they don't need to save, etc. They keep spending. There could be another dynamic that started. So because there's less investment, because we've slowed the money supply, there'll be less investment and there'll be less money spent on capital goods. Remember, capital goods produce consumer goods, and so this might slow the supply. Aggregate supply may slow down and can cause cost push inflation. So you might end up with another type of inflation instead because of the reduction in capital goods. So it might not always work the way we want it to. Also, decreasing interest rates might not work because, again, it depends on the consumers. If they're reasonably pessimistic, even with reduced interest rates, they might not spend and they might not invest. If they're not very confident, questa fiducia isn't present, then it won't have the desired effect. Or maybe the central bank already has very low interest rates. We've had a period of incredibly low interest rates and there might not be anywhere to go. If you've got 1% interest rate, what do you reduce it to? So that can be a problem. There might not be enough customers that are credit worthy to lend to. So if you reduce the interest rates, if there's not the people to lend to, you're not going to increase the quantity of money. The banks will just continue as before and not increase the debt. So that's a reason why it might not work. Normally, if there's spare capacity in the economy, that means if the resources are not being used to full capacity, normally an increased money supply, an expansionary policy, will increase the national income and real output, and in that way employment. Here we see from the diagram, one second. We see here the real GDP going up. So we've increased aggregate demand with this expansionary policy, and that should increase the real GDP and maybe a little bit the prices here. So that should be the intention. A contractionary monetary policy in the same way may reduce national income and output and employment by reducing the aggregate demand. So people aren't buying so much, and that will leave more resources idle, but with less inflation. If the economy is using all the resources, a contractionary monetary policy may reduce inflation, which is the objective often, and this shouldn't affect the national income output and employment. If we look at the diagram here, we know if all resources are being used in the long term, aggregate supply can't go up. So it goes up in a straight line, just price increases, not in quantity, in real GDP. So in this way, by reducing the monetary supply, we don't actually decrease the real GDP, but we just reduce the prices. So this is a good reason for operating monetary policy, a contractionary monetary policy.